Welcome back to the Deep Dive, where we take the complex mechanisms that govern your financial life, rip them apart, and put them back together in a way that actually makes sense for you, the astute learner.
Today, we are tackling one of the single most frustrating, mandatory, and frequently misunderstood costs of achieving homeownership: mortgage insurance.
Oh, absolutely.
It's this massive expense, right? It's often just bundled into the monthly payment, and for most borrowers, it just feels like they're paying for a benefit they never actually get to use.
That sentiment right there, that's exactly why we're doing this. Our mission today is to thoroughly analyze lenders' mortgage insurance LMI, or as most people in the United States know it, private mortgage insurance, PMI.
Right.
And this deep dive is built from some really comprehensive source material comparing the costs, the mechanics, the cancellation rules, and the requirements across three major housing markets.
Yeah.
So we're looking at the United States, Australia, and Canada.
And going international is so important here.
It is. Because understanding how different nations tackle the same risk hurdle, it just provides incredible insight into your own mortgage contract.
Okay, so to set the baseline, let's just unpack the core definition immediately, because this is where all the confusion starts. What is LMI or PMI, fundamentally?
What is it really?
It is a type of insurance policy, yes, but the benefit is not payable to the homeowner. It is payable solely to the lender, the bank, the credit union, or, potentially a trustee for a pool of securities if your mortgage has been bundled up and sold.
Okay, so let's be absolutely crystal clear on this. This is not fire insurance. This is not hazard insurance to protect the structure of the house if, I don't know, the roof blows off or pipe bursts.
Precisely. Its sole singular purpose is to offset losses for the financial institution. This protection, it only kicks in if the borrower, the mortgager, is unable to repay the loan.
Okay.
And the sale of the property through foreclosure doesn't recover all of the lender's money. The remaining principal, interest, all their costs.
So in short, it protects the bank, not you.
That's it. It protects the financial institution from the risk that comes with loans that have a low equity stake from the borrower.
It's the safety net. It's what allows the lender to say yes to a loan that feels a little riskier to them, a loan to someone who hasn't quite managed to save that traditional really big 20% down payment.
Exactly. So the borrower pays the premium.
But the lender gets the coverage.
Yes. That dynamic is just crucial to remember throughout this whole discussion.
That's a key takeaway right there. The cost is borne by the one who receives zero, and I mean zero, benefit from the policy.
Well, the benefit is getting the loan, because without it, that high LTV loan likely wouldn't be issued in the first place.
That's a fair point. It's the cost of entry. So that sets the stage. We're going to begin by focusing on the complex, large, and often frustrating mechanics of PMI in the United States. We'll be focusing specifically on the financial thresholds and the costs that often remain hidden. When you talk to anyone in the U.S. about the American dream of buying a home, there's this magic number that just instantly comes up.
20%.
20%. And that brings us to our first major concept, the down payment driver. PMI is generally only required if your down payment is 20% or less of the property's sales price, or, I guess, the appraised value at the time of purchase.
And this is defined by something called the loan-to-value ratio, or LTV. If that LTV is 80% or more, the lender's risk exposure just goes way up.
Why is 80% the magic number, though, historically?
Well, historically, 20% equity, or that 80% LTV, has been recognized as the standard buffer. It's what's needed to cover the typical costs that come with a foreclosure, legal fees, maintenance, selling costs, and the drop in market value that sometimes happens with a forced sale.
Right, a distressed property.
Exactly. So if the borrower brings less than that 20% to the table, the lender needs some kind of third-party insurance to cover that expected shortfall.
And the cost isn't trivial. I mean, we're not talking about a few bucks here. It can be hundreds of dollars a month, which is why everyone tries so hard to avoid it. So let's detail how this cost is actually calculated. Our source material explains that the annual cost of PMI is generally expressed as a percentage of the total loan value. But that percentage is, well, it's highly variable.
Oh, the variance is extreme. It's completely dependent on multiple factors that reflect the borrower's risk profile. So, imagine a base loan amount of, say, $400,000. Your PMI rate could be as low as 0.5% or climb well over 1.5% of that $400,000 annually.
Wow. Okay, so let's break that down. On a $400,000 loan, 0.5% is what, $2,000 a year. So about $166 a month. But if the rate is 1.5%, that balloons to $6,000 a year.
Or $500 a month.
$500 a month. That is a substantial budget difference. So what drives that huge range?
It's driven by four main inputs. First, the LTV ratio itself. A borrower who puts 5% down, so a 95% LTV, is just inherently riskier than someone who puts 15% down. That's an 85% LTV. So the higher the LTV, the higher the rate.
Makes sense. What's number two?
Second, the loan term. A 30-year loan is generally seen as riskier than a 15-year loan.
Because you're paying down the principal so much slower.
Exactly. The principal is paid down much, much slower, which keeps the LTV high for a longer period of time.
Okay, number three.
Third, and this is a big one, the borrower's credit score, usually the FICO score. A high credit score can shave significant basis points off that PMI rate, while, a lower score can easily push you towards that expensive 1.5% or even higher range.
Then go forth.
The specific required coverage amount, this is generally dictated by the lender's exposure and the type of loan. The lender will often require coverage up to, say, 25% or 30% of the loan amount, but, and this is key, the premium is charged on the entire balance.
Okay, that's a really important distinction. And the borrower also has options for how to pay this premium, right? Which brings us to the payment methods.
Yes. While monthly payments, added to your mortgage statement are the most common, there are alternatives. The premium can be payable up front as a large single lump sum at closing.
Or, and this is where it gets a little confusing, that lump sum can be capitalized onto the loan, especially in the case of a single premium product.
Capitalization is crucial to understand. It means the lender takes that single upfront insurance premium, let's say it's $5,000, and instead of you having to pay it at closing, they just add it to your total principal.
So you borrow $400,000 plus the $5,000 premium.
Right. Your loan is now for $405,000, and you are now paying the mortgage interest rate, maybe it's 7% on that $5,000 insurance premium for the entire life of the loan.
So you make your closing costs simpler by needing less cash up front. But you significantly increase the total cost over time because you are literally paying interest on a protection product that never ever benefits you.
It is the definition of a long-term trade-off for short-term liquidity.
Yeah.
It is, and while that process kind of obscures the true long-term cost, it's still relatively transparent compared to what happens with lender-paid MI. This is what we call the invisible cost.
Yes. The hidden mechanism that drives so much of the conversation around transparency in lending. Tell us about the loan you see advertised as no MI required.
So when a lender advertises no MI required, the borrower often assumes the financial institution is just, absorbing the risk, or they have some special in-house program.
Right, like they're doing you a favor.
But the source material confirms that in the vast majority of these cases, the loan actually has lender-paid MI, or LPMI. The insurance policy still exists. The lender simply pays the premium directly to the insurance company themselves.
Okay, but since the borrower is the funding source for all expenses in a loan, that cost has to be recovered somehow. The bank isn't just eating it.
Absolutely not. The borrower funds this cost, but they do so indirectly and, invisibly. It is funded through a higher interest rate.
Ah, there it is.
So instead of qualifying for, let's say, a 6.5% rate with a separate monthly PMI payment, the borrower might get a 7.0% or 7.25% rate with no MI. That extra half a point or 3/4 of a point over a 30-year loan term is calculated to fully cover the cost of that LPMI premium, plus, of course, a profit margin for the lender.
So you're still paying for the insurance. It's just completely laundered through the interest rate. It makes it look like a seamless feature of the loan itself, rather than a separate, distinct, and this is the most important part, extinguishable cost.
And that is the core insight that changes how you analyze these loans. Borrowers typically have absolutely no knowledge of the existence of any lender-paid MI. They just sign a contract with a slightly elevated interest rate.
The implication there is huge.
It is. With borrower-paid MI, or BPMI, you have a separate line item. You can see it, and you can work diligently to eliminate it. With LPMI, you've paid the cost, but that higher interest rate is now fixed for the life of the loan. You can't get rid of it.
That distinction is paramount. If the whole goal of LMI is to protect the lender, and the cost is always passed on to the borrower, then transparency about that cost is critical.
But wait, doesn't the LPMI model simplify things for the borrower? Removes a line item, you avoid the hassle of cancellation.
It does simplify it in the short term, yes.
Right.
But the trade-off is the loss of financial flexibility. If your home value skyrockets, or if you diligently pay down the principal early, a borrower with BPMI can cancel that monthly cost and pocket the savings.
But the LPMI borrower.
A borrower with LPMI is stuck paying that higher interest rate for 30 years, regardless of how much equity they build. The cost is permanent.
In effect, LPMI is the lender saying, we'll manage the risk for you, but you'll pay us for that management fee forever. It just completely removes the borrower's ability to capitalize on building equity early.
Yes.
That lack of control and transparency is really what makes the structure so contentious. And it's why understanding these two options, BPMI versus LPMI, is so vital at the closing table. If you want the option to ditch the insurance later, you have to choose BPMI, even though it results in a lower interest rate combined with that separate monthly insurance premium.
That provides a really robust understanding of the U.S. mechanics and the insidious nature of some of these hidden costs. But now let's tackle the biggest hurdle for U.S. homeowners. The complex, often frustrating rules governing how you get this costly insurance off your back once and for all. For a borrower with a large loan, the effective interest savings from removing or paying off PMI can be truly substantial. We're talking hundreds of dollars a month, which is pure cash flow relief.
It's huge.
But the rules for cancellation are not universal, and this is a major, major area of confusion, so we need to draw a really clear line between conventional loans and FHA loans.
This contrast is absolutely fundamental for any current or future homeowner. If you have a conventional mortgage, that's one that is not insured by a government agency, the rules for PMI cancellation are governed by a federal law. It's the Homeowners Protection Act of 1998, or HPA.
And under that law,
PMI is often no longer required once the principal hits that 80% LTV threshold.
and just to remind everyone that LTV reduction can happen in two primary ways.
Right.
Paying down the principal or the house value going up.
Yes. The first way is just simul amortization. You diligently pay down the principal over time until the loan amount is 80% of the original purchase price. The second way, the more exciting way, is through home value appreciation.
Right.
If the market value of your house increases significantly, say you bought for $500,000 and now it's worth $625,000, well, your LTV drops to 80%, even if you haven't paid down the loan all that much. And that triggers the possibility of early cancellation.
Okay, that sounds relatively straightforward. Now contrast that smooth path with the FHA loan. This is a government-insured mortgage. It's really popular among first-time buyers and people with lower down payments or lower credit scores.
And our source material highlights a critical, often financially devastating caveat for many FHA borrowers.
What's that?
FHA loans carry a specific insurance than mortgage insurance premium, or MIP. And the rules for removing MIP are brutally restrictive compared to conventional PMI. They often require the borrower to refinance the entire loan into a conventional product to get rid of the insurance premium, even once the LTV drops well below 80%.
Wait, why does the FHA MIP stick so tenaciously to the loan? Why is it so hard to get rid of?
It depends on when the loan originated and the size of the initial down payment. The rules have changed over time, but generally, if the borrower put down less than 10% cash, the MIP is required for the entire life of the loan.
The entire life of the loan.
The entire life. Think about that. A 30-year FHA loan with 5% down means 30 years of insurance payments, regardless of how fast you pay down the principal.
That is a colossal difference. So if I put down 5% on a $400,000 FHA loan, I could be paying that insurance for decades. That could be tens of thousands of dollars. Whereas if I had a conventional loan, I could maybe cancel after, 5 to 7 years?
That's right. And the only way out of that FHA trap is a costly refinance.
And a refinance isn't free?
No. Refinancing involves new closing costs, a new appraisal, title fees, underwriting paperwork. It can easily eat up 1 or 2 years' worth of any potential PMI savings. So while FHA loans are great for getting into a home initially, understanding the lifelong burden of the MIP is just crucial to calculating the true total cost.
This just emphasizes why knowing your specific loan type and its cancellation mechanism is probably the most important financial insight a new homeowner can possess.
And beyond the loan type, there is also the federal legal obligation, the HPA, which dictates when a lender must allow you to drop the insurance, even if they're being slow or resistive. This is the 78% rule.
Okay, we've established that 80% LTV is the trigger to start asking about PMI removal. But legally, the lender is not obligated to allow cancellation until the loan has amortized to a 78% LTV ratio.
Right, and that 78% ratio has to be based on the original purchase price of the home, not any appreciated current value.
So what's that 2% difference for? The buffer between 80% and 78%.
It's entirely a lender safeguard. As we noted, foreclosure and sale costs are expensive. So if a borrower defaults right at the 80% threshold, there's a pretty good chance the property sale won't cover the remaining 80% principal plus all those transaction costs.
So the 2% is literally the lender pricing in the cost of a potential forced sale. It gives them a small mandatory cushion before they are legally forced to operate without the insurance.
Precisely. The federal law mandates that once you hit 78% based on that original amortization schedule, the cancellation should be automatic, regardless of whether you requested it.
But waiting for the automatic 78% cancellation could take years. It could take a decade, depending on your amortization schedule. What about the process for trying to cancel early at 80% LTV because my house value went up?
That's where the borrower has to become proactive. The first critical step is that the borrower must initiate the request for cancellation. You have to set it to the servicer of the mortgage. This is not automatic at 80%. It requires you, the borrower, to formally communicate the request.
So if I just sit back and keep paying, the lender is happy to keep collecting that monthly insurance fee, even if I hit 80% equity early.
That is often the unfortunate reality. Yes, once the borrower initiates the request, the servicer contacts the PMI company. But here's the hurdle. If you are basing your cancellation request on home appreciation, the servicer will almost always require a new appraisal,
Paid for by me, the borrower.
paid for by the borrower to determine the current LTV ratio.
That appraisal fee, which can easily be $500 or more, that becomes part of the negotiation. I have to weigh the cost of the appraisal against the savings of, say, 6 months of PMI payments.
It's another small barrier designed to make the borrower prove the risk has genuinely decreased. And furthermore, the lender will check the loan's history. To cancel early at 80% LTV, your payment history has to be excellent.
Ah,
If you've missed payments, especially in the last year, the lender has the contractual right to refuse the cancellation. They'll cite that the default risk is still elevated. You might have to cure the loan history by maintaining perfect payments for a period before they'll reevaluate.
and we can't forget the fixed period exception we identified. Even if a borrower hits 80% equity early, some contracts stipulate that PMI has to be paid for a minimum amount of time.
Yes, often 2 or 3 years. This stipulation is usually buried deep in the initial closing documents. A borrower might be excited to pay down the loan in 18 months, only to find they're contractually obligated to pay the PMI for another 18 months, even though their equity position is already secure,
It's a non-negotiable term.
set by the lender at the outset to ensure they recover a minimum amount of insurance premium.
The complexity of cancellation, I mean, it's dependent on loan type, appraisal cost, payment history, these fixed duration clauses. It's exactly why some borrowers, even those without the full 20% cash, aggressively seek ways to avoid PMI entirely, which moves us perfectly into Section 3. The alternative strategy known as the piggyback loan. Okay, let's unpack this counter strategy. For a borrower who lacks the full 20% down payment required to avoid PMI, the goal shifts. It moves from minimizing monthly cost to, well, manipulating the LTV ratio of the primary mortgage.
Yes.
And they achieve this by utilizing a second mortgage, the piggyback loan, to cover the shortfall.
The core logic here is simple, but it's actually brilliant in its application. The primary mortgage, which is almost always the one with the most favorable rate and the largest principal, must be kept at or below 80% LTV.
So you're protecting that big loan.
You're protecting the big loan. By isolating the high-risk portion of the debt into a separate, smaller secondary loan, the main lender avoids triggering the mandatory PMI requirement on that massive primary loan amount.
So the borrower uses the piggyback loan to act as their down payment gap filler. Our source material highlights two incredibly popular arrangements that make this clear. Let's start with the classic 80-10-10 setup.
Okay, in the 80-10-10 arrangement, the numbers break down like this. 80% is the primary lower interest mortgage. 10% is the second mortgage, the piggyback, which is usually at a much higher interest rate.
And the final 10%.
The final 10% is the actual cash down payment made by the borrower. So the buyer only needs 10% cash up front, but the primary loan avoids PMI.
Or, for the truly cash-strapped first-time buyer, there's the 81-55 program.
Correct. Here, the primary mortgage is still 80%, but the second mortgage jumps to 15%, and the borrower only has to provide a 5% down payment.
That's incredible access.
That 5% down option provides amazing access to the market, but that 15% secondary loan is expensive. These secondary loans, they're often structured as home equity lines of credit or AELOCs or simple second mortgages, and they often carry adjustable rates that begin much higher than the primary loan's fixed rate.
So the borrower now has two payments, often to two different lenders, and one potentially fluctuating interest rate. Why would anyone choose this complex multi-loan arrangement over just taking one loan and paying monthly PMI?
Historically, the cost advantage, or at least the perceived cost advantage, was massive, and it was almost entirely driven by the intricacies of U.S. tax law. Before 2007, mortgage interest payments, including the interest paid on that secondary piggyback loan, might be deductible on your federal income taxes.
Depending on your situation and if you itemized.
Exactly, but the key part is the contrast. PMI premiums were not deductible until 2007.
So that's the arbitrage.
That's it. This created a lucrative financial opportunity. Let's use our $400,000 loan example. If the 10% piggyback loan was $40,000 and the interest rate was high, say 9%, the borrower would pay $3,600 in interest the first year. That $3,600 might be deductible.
Okay.
But if the PMI on the primary loan was $2,000 annually, that was $2,000 of pure non-deductible expense.
So by using the piggyback loan, the borrower transformed a pure non-deductible expense, the PMI, into a potentially deductible interest payment, which would lower their overall taxable income. And that often made the total all-in cost of borrowing substantially cheaper, even if the secondary loan's interest rate was exorbitant.
The source material is clear that this dynamic heavily favored the piggyback strategy. It was a market inefficiency created purely by the U.S. tax code, and it forced lenders and buyers into these complex dual loan structures just to optimize their tax position.
This successful strategy eventually required a response from Congress, which led to the complex and temporary timeline of the PMI tax deduction. So let's detail the history of this deduction, starting with its inception in 2007.
Right. The ability to deduct PMI was introduced specifically to level the playing field between the piggyback strategy and the single loan with insurance. So mortgage insurance became tax deductible in the U.S. starting in 2007, and it allowed eligible homeowners to itemize the cost of their PMI premiums.
And crucially, this was not a deduction for everybody. It was targeted at a specific income demographic.
That's right. The original provision, it was passed as part of the Tax Relief and Healthcare Act of 2006. It provided an itemized deduction for the cost of PMI, but only for homeowners earning up to $109,000 annually.
So it primarily benefited moderate and middle-income borrowers, the ones who were most sensitive to the cash flow burden of PMI in the first place.
Correct. And the initial legislative window was incredibly short, which suggests Congress kind of viewed this as a temporary fix or maybe a pilot program.
What was the window?
It applied only to mortgage contracts issued after December 31st, 2006 and before January 1st, 2010. Furthermore, and this is a key detail, it did not apply to existing PMI contracts that predated the law.
So if you bought your home in 2005 and were paying PMI, you couldn't suddenly claim the deduction in 2007.
No, you were out of luck.
That detail really emphasizes that the law was aimed at incentivizing new home purchases and creating tax parity moving forward, rather than providing some broad retroactive benefit to the entire mortgage market.
Exactly. But here's the longevity puzzle. Though it was designed as a short-term 3-year benefit, it proved politically popular and necessary. So Congress repeatedly extended this provision year after year.
So what's the most recent comprehensive timeline based on our source material? When was this a reliable benefit?
Well, PMI was tax deductible for all years from its inception in 2007 through all the various extensions right up until the tax year 2021. So for 15 years, it was a consistent fixture in tax planning for eligible moderate-income homeowners.
But the pendulum swings constantly in tax policy.
Yeah.
What is the current status, which our sources confirm as of early 2023?
The provision was not extended by Congress for the 2022 tax year. Therefore, according to the IRS, the PMI deduction is not allowed for 2022.
Wow.
This means that a financial strategy that was viable for over a decade and a half has now lapsed. It returns the advantage, potentially, back to the piggyback loan strategy, provided the interest on that second loan remains deductible.
It's just remarkable how tax policy can inadvertently create, destroy, or revive multi-billion-dollar market strategies like the piggyback loan almost overnight.
It really is.
For the borrower, this means you can't just assume any financial benefit will last. You have to analyze the true cost of PMI every single year based on the current tax law.
It raises a powerful point for any long-term learner. Evaluating a mortgage requires considering not only the immediate costs, but also the potential interaction with a constantly shifting and dynamic tax code.
Now that we've thoroughly unpacked the American system, its hidden cost, complex cancellation rules, and historical tax complexities, it's time to put this into global perspective. We promised a comprehensive deep dive, and that brings us to Section 4, where we contrast the U.S. model with the LMI structures in Australia and Canada.
We signal a major shift here. In the U.S., LMI is largely a variable, ongoing private market cost that's subject to complex negotiation and cancellation. As we move internationally, particularly to Australia and Canada, we encounter these highly regulated systems featuring vastly different payment structures and regulatory triggers.
Let's start with mortgage insurance in Australia. Our source material names the key insurers that dominate that market.
The two main mortgage insurers in Australia are Helia, which used to be called Genworth, and QBE LMI. They function similarly to U.S. private insurers, offering policies to mitigate lender risk.
Okay, now let's look at the loan-to-value thresholds, or LVR as they call them down there. Standard practice requires LMI to be payable if the LVR is above 80%. So that aligns precisely with the U.S. conventional standard.
It does. But there's a crucial nuance built into the Australian system that's based on borrower risk.
Okay, what is it?
That nuance is the treatment of low document loans. These are mortgages issued to borrowers, often self-employed people, contractors, or small business owners, who may not have the standard proof of stable long-term income that's required by typical lending guidelines.
Right, the low doc loan.
And crucially, for these low document loans, LMI is required if the LVR is above 60%.
Wait, 50% LVR means the borrower has put down 40% equity. That is a massive, incredibly safe chunk of equity. Why would LMI be required that early for a low document loan?
Because the lender perceives the risk not primarily in the property collateral, but in the repayment capacity of the borrower. It's about income volatility and less rigorous documentation. That 40% equity might be sufficient to cover a sale, but the risk of default itself is higher. So the lower LVR threshold, 60%, is the mechanism lenders use to compensate for that increased credit risk that's inherent in the low doc category. The LMI protection kicks in much sooner to safeguard against the risk of the loan just becoming non-performing.
That structural difference is a brilliant mechanism for segmenting risk. So if your income is less proven, you face an LMI requirement much earlier in the lending process.
It creates a dual-tier system. You have an 80% LVR trigger for standard loans with full documentation and a much tighter 60% LVR trigger for those with perceived income risk.
But the most significant structural contrast with the U.S. system has to be the payment method. While the U.S. often uses those continuous monthly premiums, Australia uses a very different approach.
Yes. The LMI premium in Australia is structured as a one-off fee. It is a single, non-recurring premium paid at the time of closing. This fee is calculated on a sliding scale, based on the loan amount and the specific LVR, just like in the U.S., but the entire cost is paid in one go.
A single fee. That radically changes the borrower's administrative life.
Yeah.
I mean, if the cost is paid up front, there are no ongoing monthly payments to worry about, no cancellation rules to fight, and no debates over new appraisals at 80% or 78% LTV.
It simplifies the latter half of the loan life immensely. And just like the U.S. single premium option, this one-off fee is almost always capitalized onto the loan amount. So the borrower doesn't have to produce the cash for the LMI premium up front, but they do pay interest on that fee over the full loan term.
Okay, so while that eliminates the cancellation conundrum, Australian borrowers face a unique regulatory cost that U.S. borrowers generally avoid, and that's state government stamp duty.
Stamp duty, which is essentially a state-level tax, may be payable on the LMI premium itself. This can add thousands of dollars to the upfront costs depending on the state and the size of the premium, making the transaction significantly more expensive.
So it's an extra layer of regulatory burden.
It is, and it needs to be factored into the LMI calculation, unlike in the U.S. where PMI deductibility, when it was available, was at the federal level.
And what about that lender practice nuance you identified in the source material?
The material notes that some non-bank lenders in Australia, they obtain LMI for every single loan they issue, regardless of the LVR.
Every single one.
Every loan. However, if the loan is below 80% LVR, the lender covers the premium costs themselves. And this isn't necessarily about individual risk management. It suggests a preference for portfolio management.
How so?
Well, having 100% of their mortgages insured simplifies their ability to package and sell those loans on the secondary market, a process we know as securitization. The insurance layer provides uniformity and safety to investors, which justifies the lender absorbing the cost on those low-risk loans.
That really reinforces the idea that LMI is a systemic risk management tool. It's used not just to protect against individual default, but to facilitate the larger business of lending and secondary market sales.
It's a sophisticated use of the insurance mechanism. Now let's pivot entirely and look north to Canada, where the system is defined by a strong, public regulatory imperative.
The Canadian structure is the clearest example of government-mandated risk control in lending that we've seen.
That's absolutely right. In Canada, the rules are governed by federal statutes like the Bank Act, and these laws explicitly prohibit most federally regulated lending institutions, banks, credit unions, caisses populaires, from providing uninsured mortgages if the LTV is greater than 80%.
So unlike the U.S., where 80% LTV is a trigger for the lender to decide they want PMI, in Canada, it is a regulatory wall. If a bank wants to lend above 80% LTV, that mortgage must be insured. It's mandatory for high LTV mortgages.
And this mandatory structure significantly strengthens the stability of the entire Canadian financial system. The primary provider of this insurance and a source of transparent premium rates is the Canada Mortgage and Housing Corporation, or CMHC.
That's a Crown corporation, right? Government-owned.
It is. And since CMHC is essentially the market standard, let's look at their premium structure. How do the rates vary based on LTV?
Yeah, how does that work?
CMHC provides a very clear, transparent, and structured premium schedule. The rates are based solely on the LTV ratio, which takes a lot of the complexity and variability out of the process that we see in the U.S., where credit score, loan term, and coverage amount all factor in so heavily.
Give us the breakdown.
The rates start relatively low. For a loan with 80% LTV, where insurance is optional but sometimes chosen, the premium might be around 1% of the loan principal. However, as the LTV increases toward the maximum allowed limit, the premium rate climbs significantly.
And I recall the maximum insured LTV is quite high.
Yes. The maximum LTV allowed for insured mortgages in Canada is 95%. So the minimum down payment is 5%. For a 95% LTV loan, the CMHC premium rate jumps to 2.75% of the loan principal.
Okay, so the penalty for having a very small down payment is explicitly high. It's designed to encourage larger down payments, but still provides access to the market for those who need it.
Exactly. This clear, regulator-mandated premium schedule directly ties risk to cost without the added complexities of private insurer negotiations or the tax volatility we discussed in the U.S. It's a system designed for financial stability and standardization.
The comparison is truly fascinating. We've examined 3 distinct global models operating around this universal 80% LTV risk threshold.
We have.
You have the U.S., defined by its complex, negotiable, ongoing payments, hidden costs, and tax policy arbitrage. Then Australia, using a simple one-off, capitalized fee and dual risk thresholds for different borrower profiles. And finally, Canada, with its regulatory mandate, standardized public premium schedules, and guaranteed financial stability for high LTV loans.
For the learner in the audience, understanding these structural differences, the ongoing cost versus the one-off fee, and the voluntary trigger versus the regulatory mandate is absolutely key to navigating global finance or just simply analyzing your own loan. #OutTRO, synthesizing takeaways, and provocative thought.
This has been an incredibly detailed deep dive into risk, regulation, and the true cost of housing access. To synthesize the core knowledge for you, we established that LMI or PMI is not there to protect you as a homeowner.
No.
It is strictly a lender protection tool, and it's fundamentally tied to high loan-to-value ratios, generally above that 80% safety buffer.
And we learned that the method of bearing this cost varies drastically. In the U.S., it often involves ongoing monthly payments, the BPMI, subject to complex rules for cancellation that depend entirely on whether your loan is conventional, utilizing the 78% legal amortization rule, or an FHA loan, which often traps the borrower into a costly refinance just to escape lifetime MIP payments.
We then contrasted that with the structural simplicity internationally. Australia uses a one-off capitalized fee, which just cuts out that ongoing cancellation battle, while maintaining strict 60% LVR triggers for riskier low-doc loans.
Meanwhile, Canada features a regulator-mandated threshold insurance is compulsory above 80% LTV with standardized premium schedules provided by the government's own CMHC.
The key comparative insight here is that while the 80% LTV ratio is a universal signal for increased lender risk, the mechanism used to mitigate that risk ranges from a continuous, flexible private market product in the U.S. to a standardized upfront fee market in Australia to a mandatory publicly regulated product in Canada.
It just shows vastly different national philosophies on how to socialize or individualize financial risk within the housing market.
But there's one point we drilled down on in the U.S. section that really deserves a final moment of reflection, as it ties back to the fundamental idea of financial transparency.
You're referring to the mechanism of lender-paid MI, the invisible costs.
Yes. The reality that the lender pays the MI and then recoups that cost by silently bundling it into a higher permanent interest rate.
Yeah.
The borrower has no knowledge of the specific insurance product they are funding. They are simply paying more for the loan, and they lose the option to ever cancel that hidden cost, regardless of how much equity they accumulate.
It's the ultimate example of a necessary risk cost being concealed within a simpler product structure. And while it's administratively easier for the lender, it completely removes the borrower's control and visibility.
And that leads us to our final provocative thought for you to consider, building on the source material we analyzed today. We focused on lender-paid MI being hidden in a higher interest rate, a required risk management cost that the borrower funds without explicit knowledge. This raises a fundamental question about transparency across the entire financial landscape.
What other necessary but hidden risk management costs are buried in the standard interest rates or administrative fees of major financial products that we take for granted?
Think beyond mortgages. Consider auto loans, where the stated interest rate might also be absorbing a cost for the lender to insure against mass default. Or perhaps credit card interest rates, where a component of that rate is dedicated not just to profit, but to insuring the institution against fraud losses or high-risk borrowers.
If you start pulling on that thread, you realize that the headline interest rate is rarely the full story of who is paying for whose protection and how much control you truly have over reducing those mandatory costs. Understanding LMI is just the entry point to understanding the complex web of risk sharing between you and your financial institution.
A perfect place to end. Thank you for diving deep with us. We'll catch you next time.